Half an hour away from the opens of Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Let's get to your top stories this Tuesday morning. Japanese stocks gaining on this return from a long weekend with a weaker yen seen providing some support for exporter stocks. Markets overall are stable, at least for now, ahead of the key U.S. inflation print. Now, Haven plays in focus amidst on rising, at least, geopolitical risk here with Israel bracing for a potential strike from Iran. Plus, Chinese brokerages are said to be cutting back trading of government debt to help cool a bond rally, with some rural banks told not to settle their trades.
All right, take a look at the market action here. Japan coming back online after that holiday, and certainly it seems like this rebound continues for another day in Asia. In fact, you take a look at how the MXAP, the MSCI Asia Pacific Index, are actually back to those levels that we saw before that route just a week ago. So, are really calmer heads prevailing here right now? Is this really something that can be long-lasting, just given that some of these root causes of the rout are still in some ways in place here right now? But certainly when it comes to equity traders, they're still looking to buy on this dip and continuing on here this morning. U.S. futures are also punching higher. Dollar is flat. We're watching very closely what happens with dollar yen. We're at 147 levels right now. So it seems like we're still seeing some weakness, but we're tracking very closely the havens. So whether it's treasuries, whether it's oil markets as well, now that we start to see some more lines from the U.S. warning that we potentially could see some sort of attack from Iran this week. So that certainly is leading to a little bit of oil markets elevated. Right now, we're sliding a bit after a 5-day rally when it comes to oil markets. So we're back above $80 for Brent. We're having around 81. Gold's catching a bit here this morning as well. And you're not seeing that much in terms of treasuries, though, this morning. But you take a look at how some other sort of gauges of oil and what we're looking at in terms of that geopolitical risk. You're starting to see that in China futures as well this morning. There you go. We're seeing that pop of 3.6% in Shanghai. New York crude is back below that $80, though. We briefly touched above that. Copper, we talked about a little bit of rebound there from some of the lows that we've seen, and also talking a bit more the energy complex here and how these energy stocks are going to react, seeing a little bit of upside on the back of some of these tensions here. One maybe thing that put a floor on, or at least put a top on this oil story, might be what we saw from Ukraine and Russia, planning to keep gas flowing as fighting continues there as well. Dave.
Yeah, and we'll talk more about the commodity complex in about 30 minutes. And Goldman Sachs will be joining us to talk us through the equity components of some of these declines we're seeing in the metal space as well. Now, speaking of, just very briefly, so Yvonne talked about the CGB sell-off, and the worst day for 10-year futures on Monday, going back to early of 2023. We're opening stable, so watch for what happens with yield. I think we're up about 12, 13 basis points over the last few days or so. Oil prices, given, of course, what we just talked about there, and we are seeing about a 3-4% move in Shanghai crude, but you take that, of course, from late afternoon. Yesterday, a couple of earnings reactions, maybe KE Holdings, you had a big move up overnight. Watch that closely today. We are in the window for data as well still. FDI numbers and also credit numbers are said to come through today. And of course, not on your screens as well is any reaction to the changes from MSCI. They've effectively removed about 60 Chinese stocks from their emerging markets index. They've added to this rebalancing in favor of other EMs like India, for example. Any market reaction we will be watching, of course, towards the open today.
Yep, we're definitely watching what CGBs, as Dave mentioned, right? This bond rally seems to be broken. How long is it going to last? It seems like what policymakers are doing right now seem to be working for now, after we saw, of course, 10-year yields are back to, 3-week highs in particular. And we're continuing to see they're opening sideways after that Monday rout here today. And what we're hearing from regulators are said to be taking some of the most extreme measures yet to cool this bond market rally. Sources say commercial banks in Jiangxi province have been told not to settle their purchases of government debt. Our China correspondent Min Min Lo joins us in Hong Kong. So what's going on here?
Yeah, so yesterday, several rural banks in Jiangxi province had failed to settle their debt after the authorities told them to stop buying government bonds. And as far as we understand, this came as after the officials initially rescinded that order before reinstating them later, which suggests that there is some level of maybe chaos or struggle among local officials to find the right balance here as they try to intervene in this market. Because analysts say that this is quite extreme. It could undermine market integrity if the counterparties then start to worry about more failed transactions in the future. And this also comes after the local authorities in Jiangsu province, that's another province in East China, told the rural banks to stop buying bonds as well. And these are the banks that tend to be the most aggressive in buying the sovereign bonds. Some of them have as much as more than a quarter of their assets in bonds. And so that exposes them to more risk because they also have a weaker balance sheet to protect themselves against the risk.
And so that's the bank side. On the brokerage front, we understand at least 3 or 4 of these brokerages have also been cutting back on trading in fixed income, and bonds specifically.
Yes, at least 4 of them have said that they are cutting back on bond trading, and one of them said they are suspending trading for certain maturities as well. Most of them are saying that this is a voluntary move, but at least one is saying that they are taking guidance from the authorities. And this is just the latest in a series of measures, because yesterday we also saw the state banks selling again 100 million yuan batches of the 7-year note, and that's why we saw that bond yield for the 10-year note going up by 4 basis points yesterday. 2.24% is the highest we've seen in 3 weeks. And then you also have the volumes coming down by 45% compared to the highs of last week on Tuesday. I'm talking about the volumes of transaction for the most actively traded 10-year bond. And this comes after, the state banks were asked to keep a record of who is buying up those sovereign bonds, regulators slowing down the approvals of new bond funds. So quite a number of measures working in tandem to reverse this bond rally. But as our MLive colleagues are saying, if the bond rally is broken, the big challenge next is to restore the market confidence, especially with market transparency being reduced by these interventions so far.
You mentioned about market confidence. We had an interesting headline that came out about the amount of money being pulled from foreign investors last quarter. It was a record amount.
Yeah, $15 billion to be exact for the second quarter. That's the second time that we are seeing a negative print. The first half of the year, investors pulled out $5 billion from the Chinese economy. So if this trend continues, then we could see potentially for the first time China having a net annual outflow of investment, at least since the data became available. And this is a number of factors at play. Again, the geopolitics, risk companies trying to cut their exposure from China. You have the weak domestic economy. China's surprise advancements in areas like EVs have forced some companies to scale back investment in China. And you also have Chinese companies sending record amounts of money overseas as well, $71 billion in the second quarter, up 80% from the same period last year. Again, trying to hedge against those geopolitical risks by investing in plants overseas. And also those interest rate differentials as well. That makes more sense for companies to put their money overseas rather than in China.
Min, thank you so much. Min Lo, our China correspondent. Our guest coming up on the show in a couple of minutes is John Lin. And to Min's last point there, he's noticed an almost permanent change in the nature of this A-share market, this structural trend of value outperforming growth. So given these changing times, John Lin's insights will be very much in focus amidst this downdraft we're seeing in the onshore market. Stay tuned for that, of course, in a couple of minutes. In the meantime, our other top story is this imminent attack on Israel here from Iran. The U.S. believes one, of course, is forthcoming, may come as soon as this week, in fact, here as leaders continue to work to de-escalate tensions in the region. Bill Ferries, our Asia senior editor, joins us right now. And Bill, what do we know from what the Americans said on how soon we could see Iran retaliate?
Well, John Kirby, who's the spokesman for the U.S. National Security Council, told reporters today that they believe there could be a significant set of attacks coming. They believe that those attacks could be coming, as you said, within the next several days. There's still some uncertainty. Will this be an attack that's coordinated with Hezbollah and the Houthi rebels? Will it just come from Iran? On which fronts will it happen? But there is this feeling among U.S. intelligence officials in the Biden administration that response to the killing of Hamas's political leader now more than a week ago is now something that's going to happen within hours or days.
We're hearing that the U.S. is also shoring up naval and air forces in the Middle East to sort of fend off. And of course, this is going to bolster Israel's sort of defenses here. To what extent do you think that's really going to deter Iran from doing anything?
Well, it's interesting. Iran launched a very large attack. It was really the first attack from Iranian soil against Israel in April. That involved a barrage of 300 drones and missiles. That was shot down in part by Israel's Iron Dome system and their other defenses, but it was also something that U.S. and its allies helped defend against. So those forces can provide defense. Whether they provide deterrence, as you asked, is a different issue. I think Iran has made clear it expects it will respond to this in some degree. The question is whether their response prompts kind of more of a full-blown war, or whether it's seen as having enough of an impact to allow them to de-escalate and perhaps even go forward with some of these peace talks that have been scheduled for later in the week.
Bill, I think Axios reported that Antony Blinken is headed to that part of the world Tuesday, so I would imagine later tonight, Asia time as well. Apart from that, if that and other things, what else should we be paying attention to the next 24 hours here?
Well, we're also waiting to see if more U.S. forces get deployed. They've announced the acceleration of the USS Abraham Lincoln aircraft carrier. That has a fleet of F-35 jets that could be used in a defense. It has not reached its destination yet. We do know the USS Georgia, a submarine with Tomahawk missiles that could be used on land attacks. That is believed to be in the region already. The U.S. doesn't typically say where its nuclear fleet is, but in this case, they've made that announcement. So they're trying to do as much as possible to prevent this attack from happening. And then the next big thing you're asking about is whether this August 15th date that the peace negotiators have set for the next round of talks really takes place or not.
Bill, thank you. Bill Ferry is our Asia senior editor, joining us out of Singapore with the latest. And of course, we're kind of down to the opens of trade in Shanghai, Shenzhen, and Hong Kong. Still looking to see whether we continue to see those CGB yields heading higher here this morning. This is the China Show.
Welcome back to shows here. A couple of seconds, if not any time. Now we should be getting the midpoint of the day on the reference rate. The forecast here from our survey is just above 718, 718.01 to be more exact here on the actual estimate. While you keep an eye on that, the currency's trading just a little bit below that stronger side. 714.79 is out now, is your midpoint of the day. We are looking at modest losses going into the open today. Of course, the heft is coming from Japan that's reopening from the long weekend and that's carrying the cross, so to speak, on the regional benchmark. We've now retraced completely all the losses from that Darwinian scramble for survival and cash this time last week. Let's bring in John Lin, China Equity CIO at AllianceBernstein, joining us out of Singapore to talk us through his calls in the market. John, good morning, and a pleasure to have you on the show. I mean, the story, at least as far as Chinese equities go, is, well, it's been relatively quiet. Yvonne and I have been focused on what's happening in the fixed income space, and I'm wondering, is what's happening in bonds affecting in any way what you do in your part of the equity corner?
Yeah, good morning, David and Yvonne. It's always good to see you guys. Short answer is yes. What you are seeing in the bond market in terms of that chase for yield or certainty of cash flow, that's being reflected in the equity market in terms of the dividend stocks outperformance. You know, I'm no economist, but I can sort of see the attractiveness of going after a set of certain cash flows, right? So, for example, with the real interest rate staying still very high onshore in China, with lackluster retail sales, with the property sector activity still falling. There is a lot of money waiting on the sidelines, and government bond with their yields as the way they are seems pretty attractive, not just for investors, but for banks, insurance companies too. Now, equally interestingly, in our part of the world, in the equity market, you can get that sort of certainty on cash flow in dividend stocks, whether these are toll road operators, ports operators, etc. They are a set of companies that do pay out quite a lot of dividends for investors. Historically, they're kind of sort of the boring part of the market. And what you're seeing is sort of mirroring what's happening in the fixed income market. The dividend stocks in my part of the world really have been outperforming really since the last couple of years.
But do you think the fact that the PBOC is trying to put a floor on CGB yields, does that dent in any way the appeal for these dividend stocks?
Short answer is probably not. First of all, trying in the short term to stem some of the funds flowing, and you know, from a security or banking regulator's point of view, that sort of makes sense, right? You want to make sure that the banking system is not overloaded with one single asset, so that then the system becomes susceptible to volatilities like Silicon Valley Bank, what happened there in the U.S. On the other hand, I think the macro backdrop we just talked about in terms of the lack of things to buy for people with the funds, you know, lack of certain returns for the likes of the insurance companies, etc. That means those are trying to stem that flow is a little bit like swimming upstream. In the equity part of the world, then, the dividend stocks, by the way, there are plenty of stocks that are still yielding you 4.5–5% in terms of repeatable cash flow that the companies give back to shareholders. Not to mention that with the 9-point guideline that came out earlier this year, particularly in the SOE space, a lot of companies are either directed or incentivized to increase the payouts. So in my part of the world, the dividend stocks, the yield are higher than CGBs today, and they have the probability or possibility of giving back even more money.
Right, and you know, that goes into your other call, John. What you now observe to be a now structural shift in favor of value stocks over growth in China. I think two-part question there is why do you think it's now structural? That's number one, and not simply a prolonged, you know, cyclical outperformance because the market hasn't done well. And number two, how has that changed the investor psyche in China, where frankly the retail investor is used to exciting bull and bear markets and not so much as boring grind up and down?
Yeah, I mean, let me answer the second part first. Right? Part of that, I think, is just the natural maturity of the marketplace. And you've seen this happen in other markets like Hong Kong or Taiwan and Korea, where over time, companies that, for example, pay out dividends in the Hong Kong space are just then preferred by particularly the legions of a retail investor base. Historically, China really never paid out much dividends, and so it's a relatively new phenomenon. It's less than a decade old. And as investors get used to this idea that, you know what, you can actually get money back from the companies in the form of dividends as a form of return, you know, I think those will start to be preferred. So the company, the market itself are simply going through this maturity cycle that we've seen over and over again in other parts of Asia. And the other part, of course, is that with the slowing economy and the arguments that we are all having about what would drive China to grow a little bit faster again, what sort of stimulus do we need? You know, it's pretty clear that today the Chinese economy is no longer sort of the go-go growth economy that we used to know in the mid-2000s or early 2010s. In that environment, companies with repeatable cash flow or forecastable cash flow and fairly certain cash flows are simply a better place to be. And really, that's no different than any other market in the world.
Yeah, as a value investor, you mentioned the industrials. You're looking more into the consumer sector as well. I'm just wondering, can you go into the specifics, given just how badly hit this sector has been?
Yeah, we generally like to look at a part of the market when everyone sort of is pulling their hair out in despair. And I think in previous times we talk about sort of when sometimes babies get thrown out with the bathwater, and we look for those opportunities, right? And today, the most pessimistic part of the market seems to be consumer, whether it's consumer staples like the white liquor space or consumer discretionary, the makers of shoes, T-shirts, winter coats, etc. With the slowing of retail sales that began to be noticed by the market starting in June, you really saw a wholesale dumping of stocks in the consumer sector in China for the last 2 months. And as a result of that, some companies are sold off in a proper way to recognize their slowing sales, but some companies are incorrectly sold off, in our opinion, because of their medium to long-term earnings power very much remain there. And those are the companies that we are really interested in today, and really have begun to buy some of those.
All right, John, I'm glad you mentioned liquor. In 10, 15 seconds or so, apart from that, any specific sector you're looking ahead to as far as the earnings season goes? We're going into the thick of things, very quickly.
Yeah, I mean, the sort of export-dominated industrial sector continues to be very interesting, and by that I meant those companies that have a niche leading business model, bus makers, forklift makers, etc., that exports to other emerging markets. Those are squarely interesting, sort of from our point of view, because of the continued strength in the emerging market space overall.
John, great to have you. John Lin there, Chief Investment Officer of China Equities at AllianceBernstein, joining us out of Singapore. Your pre-market just opening up here in the Hang Seng is looking like this. Looks like joining in again on this sort of rally that we're seeing across Asian equities here today. And we're seeing CGBs stable this morning, 224 for your Chinese 10-year yield. This is Bloomberg.
Okay, the Tuesday session, a couple of minutes away here. We're set to open mixed to maybe slightly higher. We'll see what the rest of the region does, of course. It's certainly only Japan that's moving to the upside here. Some analyst action to tell you about.
Yeah, we're taking a look at some when it comes to SMICs, the chip space as well here this morning. Also, when it comes to a good note from Chalco here from Jefferies on their price outlook when it comes to aluminum. So when it comes to Chalco and China Hongqiao, buy ratings for both of those, saying that positive aluminum price outlook there. They say demand from EVs and solar likely the new drivers and really offsetting that decline in construction. We got the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets, and we talk about how quiet, really Greater China markets have been. The global equity rally we saw in the U.S. session was a little bit more cautious, and so we were swinging between gains and losses. Asia, though, thanks to the likes of Japan coming back from that holiday, is really kind of lifting that benchmark, and we're seeing basically Asian stocks almost forgot what happened last week. We're back to levels that we saw before August 8 as well. And Hong Kong seems to be chiming in here as well, Dave.
So much for the drama.
I know, right?
What do you have to show after all the drama?
What have we learned?
What have we learned? And most times we don't learn anything. The goldfish memory of these markets, right? So yeah, we're back to levels of two Fridays back. It's quite as Yvonne points out. That's until, of course, Iran strikes back. We're waiting for an imminent attack there based on what U.S. officials have told in that briefing as well. It could happen next few minutes, it could happen next few days, it could happen in a week or so. Certainly that move up in oil prices overnight is indicative of the market's positioning for that as well. Speaking of oil on your screens, China oil is the one, did I put it in there? Yes, there we go. Shanghai crude is up 3.3%, top row rightmost. Apart from that, though, the 10-year yield is steady after this melt up we've seen in the last 4 or 5 days. We're seeing just about slightly higher open on the CSI 300. The energy index, as you can see bottom of your screens, is moving alongside. Of course, it moved up slightly in oil prices overnight. The open in Hong Kong, MSCI China closed above the 200-day moving average on Monday. That seems to be where our starting point is. We'll unpack even more so a bit later on the changes to MSCI, and what they've done is they've effectively removed a relatively large chunk of Chinese representation in the EM basket, replace that with other weights as well. Right, other things taking place. Flip the boards, please. So you have some earnings reactions coming through. Country Garden Services out this morning, or was it yesterday? KE Holdings was out yesterday. Big move up overnight in ADRs. Big move today at 5.6%. CNOOC is, of course, an oil play. And Swire goes into the MSCI story because Swire Properties was removed effective, I think, end of the month is the effective date on MSCI changes. Speaking of some of the additions and deletions here. So addition is Huaneng, Lancang, 1% to the upside. Gangfeng, CTG, China Tourism Group, and Shida Spirits are just some of the 60 or so names that have been taken out of the EM index. In fact, just in terms of the actual number that MSCI announced today, so you had, in terms of additions, 2 additions. China changes to the EM benchmark. In terms of removals, this goes up by 58. There we go. 60 deletions from the MSCI benchmark announced a couple of hours back.
Yep.
There we go.
And of course, we've been checking commodities, given what we've been seeing. The oil price, which, after 5 days of basically a surge in oil prices, I believe when it comes to, we were seeing massive kind of gains here in the last 5 days. Things are slowing down, but in China, as you say, we're still seeing that pop in Shanghai crude this morning. Iron ore, as well as copper, those futures are all pointing quite positively here this morning. It's interesting, there was a signs of that copper rebound in the LME contract as well. Maybe there's signs of things looking a little bit better on the China demand side. We'll see. Let's get to our next guest, Trina Chen, co-head of China Equity Research at Goldman Sachs. We talk about copper, a little bit of rebound there. Iron ore is one of the worst commodities that we've seen this year. A lot of it has to do with the demand picture in China. Are you seeing signs of bottoming out?
I think from the demand perspective, perhaps copper, if we really stretch it, remains very weak on the ground. It's not getting worse. And this is one of the major disappointments, I think, in the copper market this year is because Chinese demand, in our estimate, has been contracting, actually, this year. And a lot of that has to do with later stage of property construction, the lack of start of infrastructure, and a bit of a deceleration inventory cycle of the 3 new things, EV, battery, those things. But having said that, we have seen copper sort of stay at current level in terms of the demand perspective for the past 2 months. What to look forward, I think, for the remaining of year could be, it's a very interesting point where one is we have a seasonal demand pickup from state grid, and that typically can be a pretty big driver for the fourth quarter. And the second one is at this copper price, actually, the lower it goes, the more demand it actually generates, because we had a buyer strike in the second quarter, and we're kind of sort of reversing to that. And obviously, the reverse argument also plays, you cannot go too high, and then you're going to destruct the demand again. So there's still room for demand destruction to recover. But having said that, I personally am still very cautious on copper for the third quarter because the negative inventory cycle on finished goods and the metals.
Well, can we, you mentioned 2 months that things have been stable as far as demand. Can we at least is it the safer assumption to make that demand does not falter from here?
I think it's pretty safe to say that because the biggest surprise was really taken in the second quarter. And I think that then on top of that, there was buyer strike. Okay. I wouldn't say we can never say anything for certain in this market, right? Yes. but I think as long as the copper price remains in a reasonable level, I think there's demand support. Actually, the lower it goes, the more demand support there will be. And it's also an interesting level. This is kind of where marginal cost, global, the cost level, that support is actually coming in as well.
Obviously, there's been a lot of talk about long-going debate about the overcapacity that we're seeing in some of the sectors that you cover as well. I know you have a new report that kind of talks a little bit more about this. First of all, can you kind of help us settle this debate? Is there really overcapacity? And what are Chinese corporates actually doing to adjust their plans?
Yeah. Well, thank you for bringing that up. This is a very important piece of work we've just published last week. So essentially, it's about China's overcapacity. You can put it in a different context. But no matter how you see it, there is overcapacity. So when we compare Chinese capacity versus the global demand or China demand, especially global demand, so we have quite a lot of sectors already have capacity more than the global demand pool. So some of the extreme numbers you can actually see would be solar module is now 200% of the global demand in terms of China capacity. Lithium battery is 150%. And I would say in the past 1 year, this overcapacity situation has deteriorated. So as a result, on top of all these numbers, industry are not making money. So we have nearly all the producers in the solar industry are in negative cash margin. And a lot of these industries, more than 50% actually negative cash margin. I think that's a pretty clear indication, reflection of the current status of excess capacity.
So how this is, I think, one of the graphics from this report that you put out. So let's take solar and let's take batteries, for example. How far do you think we are from industry-wide profitability? When do we? How long do we have to wait? Put it to us in years.
Yeah. Well, I mean, we have this tipping point analysis that included in the report. Essentially, we monitor the capex revision trend, so which is almost like a second derivative of producers' capex. Essentially, tells you producer on the margin, are they take out projects or are they add in projects? I think a lot of these sectors we're seeing removing of the project, or in other words, revision trending down. And interesting that you look at this chart. By the way, it's a very nice chart, better than the one I had in the report.
Oh. and you're welcome to take it.
I might. And I think the solar module, you can actually see lithium battery from capacity utilization rate has probably the biggest potential improvement. And a lot of that is the analysis based on this capex revision trend. That's the two sectors we see the most. And from tipping point perspective, I think capex could be tipped within 0 to 1 years. That's the two actually we could see inflect first. And we certainly hope, obviously you still have the construction period, but I think the market will probably start pricing in a potential rebalancing, at least the road to rebalancing of the two sectors.
But you're still saying EVs might take a little bit longer. Why
Yeah,
so?
Indeed. We need to see more, I think, more clarity in EV. I think in terms of supply response or the producer's response, still very mixed. So we have some revision up, some revision down. And obviously, there's a very clear, vicious price war that's taking place that could potentially change the perception. But at this point, if based on everything what we see, I would say we'd probably be looking at, potentially more than 2 to 3 years.
Your coverage includes gold as well, right? Does it? Gold?
Yes.
Yeah. So how do you think about some of these gold miners? How are they valued given the run-up in gold and earnings are coming through as well?
Well, I mean, we covered Zijin Mining. I mean, it's both gold and the copper company.
Okay.
Maybe 1/3 actually on the gold. I think Zijin Mining clearly, is one of the top buys we have.
Yeah. Done very well.
It has done very, very well. I mean, GS in terms of gold price forecast, we're still also looking at a pretty bullish number, $2,800 plus US$ per ounce. So that's a good, really set up for a good company and a good gold prices.
Yeah, based on this report to an overcapacity, how do you look at some of these corporates now then? I mean, in terms of how do I construct some sort of portfolio around your research now?
That's a good question. Yeah, it's a CIO question. Well, I think this report is really putting these sectors, the manufacturing sector, in terms of the cycle, and also there's a lot of long-term discussion in terms of, which sector by nature will give you better actually margin. So from cycle perspective, I think solar, lithium battery pay some attention. I know the number is crap right now, really, really not good. But I mean, that's how you play cyclical name. You play on the marginal improvement. But in the longer run, we really like air conditioner and the lithium industry. And that basically has something to do with industry structure, strong top players. You have a very steep cost curve, which differentiate the top one versus the average ones. And that actually give you basically a consolidated industry and therefore better return in the longer run.
Right. And is that because there's a part of your report that's beyond cycles?
Yes.
So is that the one that's beyond cycle? What else should we be? What is agnostic of the short-term This four-letter word you just used. Short-term challenges.
I think the short-term challenges in terms of the feedback we'd be getting really is on Chinese demand. The first question you guys ask, right? And this is not a variable we kind of move a lot as a scenario in this report. We focus on the supply, but we really have to keep eyes on the demand. I mean, there is a recognition demand will decelerate by analysts and the producers, therefore all the changes. But in terms of the dynamics versus how much demand will move, I think that we need to keep eyes on.
Trina, fantastic to speak with you. Trina Chen, co-head of China Equity Research there at Goldman Sachs. Right, just a quick look at markets right now going into 12 minutes into the cash market session. And, things are actually looking better than the opening minutes here. We're looking at gains in the order of about 0.7 to 1% on the Hong Kong benchmark. Hang Seng, better by 130 points. This is the China Show.
All right, we're getting a Bloomberg scoop here right now learning that General Motors is cutting staff in Chinese market-related departments, and soon we'll meet with local partner SAIC as part of a larger structural overhaul. Let's get to our chief North Asia correspondent, Stephen Ingles. He joins us for more. What more do we know at this point?
Well, obviously, it's a realization that things have changed in the competitive space in China. General Motors, of course, started producing in China back in 1997, the second major foreign automaker to get approval to do that. Volkswagen was the first one. They had first mover advantage, obviously, in a nation that was, increasing its middle class. People were buying cars, but the competitive landscape, as we saw when I was there at the Beijing Auto Show back in May, the Chinese competitors have really upped their game. Also, they are pushing EVs. There's such a saturated market for the middle range, and that is where General Motors and its main partner, SAIC, Shanghai Automotive, really dominated for many years with sedans and the minivans. The GL8 minivan was the luxury, essentially the limousine of China. But things have changed dramatically. People are buying EVs. They're buying domestically made Chinese-branded EVs. And you can just see the numbers. Essentially, in the most recent quarter, ending June 30th, GM lost $104 million on its China business. China's sales plunging 29%. They sold 4 million cars in China in 2017, just 2.1 million last year. So that's about half. And that has to be reflected somehow in the changes that we're likely to see, according to sources. So, yes, they're laying off people throughout the joint ventures, but they're also said to be, according to these sources, going to be meeting with their joint venture partners like SAIC to talk about significant structural overhaul that could include capacity cuts going forward at its production facilities. So, yeah, big changes for GM.
And how much of GM's problems are perhaps also shared by other foreign car makers? You were there at the car show, for example, and the lineup was almost fully a Chinese maker.
All
EVs.
of them are faced with this serious problem. Yeah. I mean, Mercedes-Benz, obviously, the Germans are trying to figure out how to get their mojo back in the China market when all the press was really dominating by BYD. They right now sell about half of all the EVs in China, or about between 30 to 50% of the EVs in China. So it's all about EVs in China right now. Yes, the ICE, the internal combustion engine, is still sold, but again, the move is really towards those lower-end EVs, affordable EVs. They're selling EVs, Chinese makers, for less than $10,000 some cases $7,000. So, interestingly, SAIC GM Wuling is the other joint venture. They make the more affordable cars. Their sales dropped less than the SAIC GM joint venture, down just 12% sales in the second quarter. They make the Hongguang Mini EV. So that might be part of this structural rework, if you will, for GM to return to profitability, because they are bleeding money right now in the China market.
Steve, thank you. Stephen Ingles there, our chief North Asia correspondent. Some other stories that we're tracking for you today. Sources say Russia and Ukraine intend to keep pipeline gas flowing to Europe, despite fighting near a transit point for the fuel. Now, it comes as Ukrainian President Volodymyr Zelensky publicly confirmed for the first time that his forces had seized a swath of Russian territory. He says the operation is being conducted to protect Ukraine's border region. Israel's sovereign debt has been cut by one notch by Fitch Ratings as a war in Gaza weighs on public finances. Fitch lowered Israel's score to A from A- plus, citing geopolitical risk. A+, I should say. Fitch analysts see the conflict in Gaza lasting into 2025 with a chance of it broadening on other fronts. Moody's Ratings, meanwhile, gave Israel its first ever sovereign downgrade in February, cutting it one notch to A2 with a negative outlook. Senior U.S. and Chinese economic officials are set for 2 days of talks in Shanghai beginning Thursday. A Treasury spokesperson says topics will cover macroeconomic and financial stability, governance of the International Monetary Fund, and capital markets issues. The meetings are part of Washington's efforts to maintain communication channels with Beijing. We got plenty more ahead. This is Bloomberg. Well, Guggenheim CIO Anne Walsh is urging the Fed to look beyond interest rates to implement monetary policy. She also told us that central bank officials need to address what she calls a bifurcated U.S. economy.
If you want to go all the way back to pre-COVID, at that time, the Fed was even talking about trying to create, remember, they have a dual mandate, right? So stable employment, stable prices. Pre-COVID, they were spending a lot more time concerning themselves with this divergence, if you will, of different earners and the underemployed, and this dichotomy that existed. I haven't heard a thing from the Fed in the last 2 years about this issue and what some call the K-shaped economy. And it'll be interesting to see if their rhetoric returns to concerning themselves with the underemployed or the under-earning part of the economy.
When the Fed raises interest rates, it's a blunt tool. It impacts everybody, but to your point, because of what pocketbooks look like, it impacts people differently. Now that we are years into this fresh monetary experiment, how does it look?
If I were at the Fed, I would be thinking about the tools that we have in the toolkit differently. I would be utilizing quantitative tightening, and to a great extent, they have. Post-COVID, $12 trillion came into the global economy from central banks everywhere. And right now, we've seen about $5 trillion has been hoovered back out. That still leaves $7 trillion sloshing around in the system globally relative to where we were before COVID. Now, adjusting that for, larger GDP and GDP growth globally, probably we need to see about $3 trillion more come out before we get to an equilibrium of where we were before COVID. I don't think the Fed really appreciates the quantitative tightening tool as much as I do, and I think as much as the markets do. Relatively speaking to their adherence to rates as like almost the only tool. It seems to me it's a very blunt instrument.
Is there a way for the Fed to more surgically target the ability to balance the haves and the have-nots?
I do think rates are important here. I believe rates should be coming down. I believe they should have come down faster. They raised rates 75 basis points after SVB failed. That's unprecedented in Fed policy action ever, to actually continue to raise rates after we've had a crisis or a moment, if you want to call it that. And so as a result, they could take that 75 basis points right off and put us back where we were in March of 2023. I think they should do that.
If we take a big step back here, you were talking about the haves and the have-nots and that widening. How much does that mean the government has to step up in the future?
Well, I think the government's already stepped up a lot. I'd like to see us spend a whole lot less. What we have done is we've moved, and by the way, I think the Fed's moved this way too, into a world of industrial policy and using large sums of money to address and advance various political and or policy causes.
That was the Guggenheim CIO Anne Walsh speaking with our colleague Shonali Bostic on Next Big Risks. You can catch the full episode now on the terminal, Bloomberg.com, or on YouTube. We're getting some lines. An interesting report from Reuters is coming out talking about how the Japan Parliament is planning to hold a special session on August 23rd to discuss the BOJ's decision last month to raise interest rates. This is according to government sources speaking to Reuters. So the special session likely to have asked the Bank of Japan Governor Ueda to attend, and right now we're just seeing how this all fares. But obviously they're having more talks about what happened and basically the fallout from it across markets. Dollar yen's at 147 levels here right now. Still continue to see a bit of weakness in that Japanese yen here. But this on the back of, even ex-BOJ members that were saying maybe they won't have to hike anymore this year, just given the wobbles and the gyrations that it caused last week.
They realized how much power they wielded.
Yes.
Because they weren't really used to, not for one, hiking interest rates, and number two, causing global eruptions.
Yes.
But we've been asking, and many people have been asking the BOJ to hike rates and been wanting the BOJ to hike rates for decades. And now that they've done so,
here we are nitpicking
again.
Right?
They did it. Anyway, you can never please anyone, right? That's the problem with this world. Everyone's offended, no one's ashamed. Anyway, earnings coming through. KE Holdings, very good gains today on the back of the earnings reported yesterday. Tencent Music reports later today. We're talking fixed income with Anitza in a couple of minutes. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI just a half hour into the session. And yeah, it's quiet. So we basically are off some of the highs already of the session, just about half an hour away I should say. We're up about 1/10%. But, the rest of Asia is still doing quite well, thanks to Japan really lifting things up, coming back from that holiday and really kind of catching up on this rebound that we've seen. But yeah, we were just talking about, it's like we forgot what happened last week, Dave, in some ways.
No. In fact, if you fell asleep on Friday, 2 Fridays ago, you woke up this morning, and, this graph actually on MSCI Asia Pacific shows you exactly what the person might feel looking at today. Like nothing happened. You just went into a long, silent slumber. The headline this morning that we were just talking about there is Asian stocks are effectively now back to levels before all that drama took place on Monday. So did we learn anything? I think was a question Yvonne was posing to our viewers earlier on. I don't know the answer to that question. Brent contracts, so we're looking at oil. Back to the story, perhaps, and the potential next catalyst for markets and negative catalyst is this massive move up 3.5% on oil prices overnight, repairing some of that back, as you can see across the Brent crude today, crude curve today on this imminent, likely strike from Iran and Israel based on some of the intelligence and commentary coming out of U.S. Defense officials. So we're watching this very, very closely. No sign just yet, but again, these things could come any time, any moment, of course. And also when it comes to the CGB space as well, this pullback we are seeing in yields on the back of that melt up, almost historic melt up in yields that took us from about 208 to about 225. Now, the worst day for 10-year bond futures in China on Monday. So we're stable after what we saw there. Asia ex-China, as Yvonne is pointing out, we're better today, really on the back and shoulders almost solely of Japan, 0.8%. As you can see, Japan on your screens, 2.3%. U.S. 2-year yield trading at 4.01 right now.
Yep, and the next guidepost to look for, we have PPI prices out of the U.S., CPI to follow on Wednesday. And of course, CPI is going to be more important, but you take a look at the PPI estimates here. It seems like things could slow down, right, on the PPI side of things, especially when it comes to core. So certainly that's going to help. But, Bloomberg Economics is talking about, does that actually mean that, core PCE is going to, see the similar sorts of trends? And they're saying perhaps not, right? We had 2 pretty good inflation prints before. But July might not give that much assurance to the Fed that maybe those price pressures are easing a bit. So they might have to wait until after the August inflation data and jobs report to actually decide on what to do in September?
Yeah. Oh, well, markets are maybe poised for disappointment in that case because we're fully priced for a cut in September, I mean. And, you know, the debate there is still, do we get 25 or 50? Now, if you go all the way to the end of the coming cycle based on current pricing, you have to go all the way to about March or April of 2026. And currently, so the question is, how deep will the Fed go in this coming easing cycle? And the answer to that question right now is we go all the way down to 3% on the Fed funds rate. That's about 9 cuts, 25 each, all the way to those dates on your screens. Right. Let's bring in Mary Nicola right now, our MLI strategist out of Singapore. Mary, with all of these things on tap, you have potential escalation in the Middle East, you have PPI, CPI coming out of the U.S. Markets seem to be abnormally calm. Let's put it that way, this Tuesday morning.
Yeah, I think they don't have a choice at this point, and they need to stay on the sidelines because at the same time, we got a massive curveball from what we saw from the non-farm payroll report, and a lot of people were caught out about how weak the jobs report was. So it's better to stay on the sidelines, especially with such market-moving events like PPI and CPI, and that will really determine the Fed's path. But of course, it comes down to that CPI print, that PPI print needs to be sort of lukewarm, so not too hot, not too cold, where it suggests there could be, some sort of stagflationary pressures in the U.S. economy, or if it's too low, then it becomes recessionary fears start igniting. So it needs to come in that sweet spot.
Yeah, that sweet spot. I'm just wondering, where is that going to be in the markets, right? I mean, the question today is really, what asset's going to react the most to that U.S. CPI print?
Yeah, we've seen a really strong rally in U.S. yields over the past month and even 3 months that we've seen. So I think a lot of it comes from what we could see in yields, and of course the fact that markets are pricing in almost a done deal for the Fed's September rate cut. So if that CPI number disappoints or suggests that the Fed needs to see one more data print, that's really going to unwind some of that rally that we've seen in bonds, and then also we could see the markets repricing the September rate cut and the rest of this year as well.
Mary, riddle us this. Yvonne and I were talking, and you and I were talking during the break, right? So we're back to levels on Asian stocks before the drama, last week on Monday. Did we learn anything from that episode? Are we any better off this time?
I think we've learned the fact that sometimes markets overreact, I think is essentially the point, especially since we've gone into this lull, as you guys mentioned, that it looks like nothing's happened. But again, it was an overreaction to one non-farm payroll print. And it almost looked, when you woke up at Monday morning, that the non-farm payroll had shown actually that jobs were being cut rather than adding, just over 100,000 jobs. So actually, it wasn't as bad as we thought. And then, of course, when ISM services came out, that was completely ignored, even though it came on the strong side. So it's almost like the market's only listening to the narrative that they want to listen at the time. But in this case, it just overreacted a little bit too much without enough evidence.
Yeah, and you mentioned about, what we're seeing across some of these haven assets, oil markets. We've hovering around that $80 level. Are markets finally listening to the geopolitical risks out there, too?
Yeah, we've had this overhang on geopolitical risk constantly coming and going for quite some time now. Obviously, tensions with Iran and with Israel still remain high. And of course, any sort of strike will reignite those fears and concerns between something even bigger coming through between these two big powers in the region. And of course, the implications on oil prices. So as a result, we're likely to see that bid for haven assets. So that bid for the Swiss franc has been one of the big ones, gold as well. And then, of course, you're going to see a jolt in oil prices. That reflection on a jolt in oil prices doesn't bode well for countries in this region who are big importers of oil and, of course, can see the impact on their currencies and, of course, their current account as well. So you need oil prices to stabilize, but that's not going away anytime soon until you see some of these tensions allay.
Mary. Thank you, Mary Nicola there, MLive strategist joining us out of Singapore. Of course, you can follow more on this story, all the day's trading on our Markets Live blog that is on the Bloomberg at MLive Go. You can get a market rundown in just one click. There's commentary analysis from Mary and her expert editors, so you can find out what's affecting market sentiment, psyche after what the week that we had, right? This is Bloomberg.
Okay, we're looking at the CGB space following the worst day for China 10-year bond futures going back to March of 2023. It had a big drop yesterday following just several reports out of China. So for one, some of these local banks are being asked to not to complete some of these trades, for example, number one. Number two is some of the brokerages have started to pare back some of their bond trading. I guess the underlying story here is officials have been pushing back at the bond rally, warning of the risk of a bubble that might be sitting if, in fact, it bursts, trouble waiting to happen on these balance sheets of many of these banks. Let's get a sense of fixed income moving forward. This and other things. Anitza is with us right now, head of Asia Fixed Income Research at UBP. Is there a bond bubble in China?
No, not particular. This is not what we think. Generally, we think, the demand would still be good. Even though, government is also trying to make sure that yield curve is upward sloping and also, control a little bit on the yield. But I think, the whole thing is basically helped in terms of, for example, benchmarking it with the bond market as well. So I just don't think, it's a bubble going on. Yeah.
Do you think what the PBOC and what these banks are doing, is it enough to keep at least yields hitting a floor, or are the fundamentals just too weak?
I think it's definitely need to, set a floor. I think, government doesn't really want the bond yield to be sort of at very low level. It's, it's also reflecting some sort of recession and concern about the economy if the yield is too low. So that's why we would say, government would try to set a floor on that.
Yeah, and what lower rates have done is it's increased some of the supply that's come offshore, right? A lot of these Chinese corporates have taken advantage of this. Do you expect supply to continue to increase, say, offshore?
Not really so much. I think given the fact that the yield differential between onshore and offshore, has enlarged, so we expect that issuer would go back to the onshore market. So we not particularly think that there would be a lot of offshore issuance in China, from China. Even if there is, basically would be sort of with the purpose of setting a benchmark, would more focus on some of the SOE, some of the middle tier kind of credit. I think it's kind of difficult at the moment.
I wanted to get your take on what happened last week. Just give this market sell-off, all this turmoil, and it seems like investors now just have short-term memory, and we're seeing equity markets back to levels that we saw maybe a week ago already. The credit markets didn't really see that big of a blowout. I mean, in terms of spreads, I'm talking about, compared to the declines that we saw across equities, for example. Why do you think that is?
Basically, I think, now we have built in quite a bit of expectations about Fed rate cut. Some of them are talking about, up to the magnitude of 50 basis points in September, which we don't think so. There's recession risk going on. I think mainly it's because people are expecting cut, and therefore they still find fixed income as a very attractive instrument to go into. Credit spread did sell off quite a bit. IG name, for example, 30 basis points. Some of the high yield 3 points, down, but recover quite quickly as well. And you can see that that basically is because demand that the people have at the moment. So I think going forward, if there's any sell off, the bigger impact will be on equities rather than fixed income, because people are, really ready to deploy cash. Talking about Fed has been talking about, market has been talking about rate cut for a long time, right? This time seems to be coming real. Yeah.
What hasn't recovered up is our Treasury yields. They haven't gone all the way back up. Do you think the Treasury market's too expensive now?
Well, at the moment, we think it's a bit overdone. I think it's technically supported. We still reckon that, that the market has been built in too much. For example, market worry about recession, but that's not our view. We think there's no recession. At the moment, it's more growth scare, slowdown, concern about slowdown growth. And therefore, we reckon that, in terms of Treasury, at this point of time, there could be some room for it, for the yield to go a little bit higher, mainly on the short end, mainly on the long end, not so much on the short end at the moment because of rate cut expectation.
How much higher for the 10-year?
Well, for example, the 10-year could potentially go back to around 4% or a little bit low 4%. 5% is where, we think would be. So that's why we recommend investors basically not to expose themselves too much on the long end, or, for example, take some profit on their long end bond, go into back, to the short data bond.
Okay. And the call around IG over high yield, IG's extremely tight. It's tightened, it blew out, then it tightened almost immediately the next day. Is there still attractiveness in terms of all-in yield in IG, or do I slightly take more risk?
Okay, basically what we are looking at would be, for example, IG. It was very attractive at the beginning of the year, but now at the moment, I would say it's reasonable. I think for some investor who still haven't deployed cash into fixed income, maybe they can start off with IG. But say DM 5-year IG at the moment is only around 4.7%. Some of the BBB here in Asia could reach around like 5.3%. I mean, it's decent, okay, but it's not, like overwhelmingly exciting. So that's why we are, asking clients, for example, to look at some short data high yield. I know the differential between IG and high yield, it's not that substantial, but think about it. If we are looking just at short dated paper, we want to enhance yield, to lock in something over 6%. I think, high yield would be something that investors should look at.
Where can I find the best carry now for investors?
I would say there's two things that I, would look into. One would be short data high yield. The other would be Bank 81, in particular European Bank 81, because those were short core days, still giving you a yield of 6-7%, which we find is really good, for carry. But really depending on investor appetite. Some of them a little bit conservative, then go for IG.
Have you noticed, these conversations around central banks really about to enter an easing cycle, and who knows how long it's going to last, right? Into the next year or so. It's picked up substantially. The Fed's going to cut, follow other central banks are going to cut. Have you noticed a noticeable pickup in inflows into fixed income because of what's taken place in the last month?
Yes, it is. I mean, like some people did have some hesitation before, not sure when the cut would be. But this time, since really going to happen. So that's why in the last, I would say, quarter, we've been seeing some, inflows into fixed income from maybe equities or from other, asset classes as well. So I would say, the trend would continue, but really depending on, how you pick the credit. We stick with quality one. I think that's important.
Yeah, that's still the Korean names.
Yeah, I like
banks in Asia.
Correct. I mean, if you're talking about what would be good here in Asia, Korean names, corporate, BBB, 5%. Some local banks here, the Bank T2, about like 6 years maturity, 5.7%. Asian Bank 81, European Bank 81, short data high yield in India. I think it's a good pick.
Right. And the notion that if we do get a slowdown, if we go to a recession, for example, why don't you think we're headed for a recession is one part of the question, because you look at the pricing in the bond markets, it seems as if a recession is more a base case than a tail risk.
Well, I mean, people are building in that it is, having a recession. But when you look at the data in the U.S., it's actually not as bad as we think. I mean, yes, it's a slowdown.
It's turning pretty quickly, though, is the point, right? That's why we're here.
Well, but you can't just, look at one data. I would say when you look at the trend, yes, maybe one or two individual data are, down substantially. But you need time to observe sort of like, what's the data coming out and form the trend. But to us would be, it's going to slow down, but, not into a recession, not as quickly as most people think.
What about inflation protected? Is there still a role for that in my portfolio? Bankers would tell you barbell your fixed income portfolio, right? Have a hedge on the other side.
Well, if you look at the inflation data in general, it's been sort of like, good control by the central bank, I would say. So, I mean, at the moment, the inflation are coming down, but just slowly. So that's why I think, on that perspective, I would prefer just a plain vanilla bond, the bonds that, I've been looking at rather than sort of inflation link at the moment.
Okay. Fun in fixed income.
Very fun.
Fantastically bad.
It will be exciting going forward.
There we go. September's upon us. Anitza there, head of fixed income research Asia at UBP. Coming up here in shows, we look at how Hong Kong's real estate slump is choking off really one of the government's most important sources of revenue. That's selling land, and that's drying up fairly quickly. We'll talk about that story next. This is Bloomberg.
Let's talk about property. Why not? As Hong Kong's property prices are languishing around an 8-year low, the prolonged downturn is choking off one of the financial hub's most important sources of government revenue. What does this mean for taxes and the like? Well, let's bring in our Hong Kong real estate reporter, Shauna Guan, joining us now. Shauna, first tell us what's happening, and specifically when it comes to that funding model from the Hong Kong government now.
Right. So in the past couple of years, we've seen that Hong Kong's property is going into a downturn, be it in the residential market or in the office sector. So what's the consequence of this is that developers are either not bidding any land, or even if they do, they submit very low prices. So the land auctions turn out to be a failure. So that has led to a conundrum for the government, because for decades, the government has relied heavily on this land sale revenue to maintain our very precious low tax system, which is crucial for our status as a business hub. But that funding model is seeing, a weight of weaknesses, because of that.
Okay, so I think the point now is, in the absence of that previous cash cow, and I think we're showing the graphic on our screens, I think the best year was over 150 billion in terms of intake. We're now barely at 20 billion. What is the government doing to offset the current absence of this revenue stream?
Right. So first of all, the government says that it is cutting expenditure, but in the long run, will be quite difficult, because Hong Kong, like many other advanced economies, is undergoing an aging population, and Hong Kong has also a bunch of very ambitious infrastructure projects that would cost billions of dollars. So, like I said, Hong Kong cannot really raise tax system, because Hong Kong's status as a business hub is based on that very system. So what the government doing now is to raise more bonds. To be sure, Hong Kong has the capacity to do so, but in the long run, Hong Kong government really has to think about the future and also the industry diversity of the city.
Yeah, I'm sure you've talked to a lot of industry people about this, right? What are some ways the government can do and should do to really diversify its revenue streams?
Yes. So for the past few decades or even century, Hong Kong has relied on the finance industry and the real estate industry. People are saying that maybe Hong Kong is time for the city to think about new industries like tech. So that we can have more economic drivers instead of those couple of industries that we've been relying on. But the problem is it will take some time. So in the short run, I think the government will resort to raising debts.
Shauna, thank you so much. Great piece there for our clients and, of course, our viewers. Check that out on the website and also the terminal. Our Hong Kong real estate reporter, Shauna Guan. You can get more on Insider's Guide here on the money and the people shaking up the finance hub in our Hong Kong edition newsletter. It's out every Thursday. You can sign up via Bloomberg.com/newsletters.
Some other corporate stories that we're following for you today. Bloomberg has learned that Johnson & Johnson cleared a key hurdle in its $6.5 billion plan to resolve thousands of lawsuits by people saying its baby powder gave them cancer. Sources say more than 75% of the group signed off on the company's settlement offer through secret balloting. And the result would help J&J's efforts to contain liability to a unit it set up to resolve the lawsuits. The litigation is ongoing. BHP Group is ramping up efforts to avoid a strike at the world's biggest copper mine. The company says it presented a new wage offer to union leaders in Chile, which includes a nearly $30,000 signing bonus and improved benefits. Failure to get the union's approval would set up a stoppage at BHP's Escondida mine, which accounts for about 5% of all the world's mined copper. All right, we are taking a look at markets here right now. Of course, we've been tracking some of these MSCI additions and deletions. That certainly is one that we're watching very closely. So they added two.
The top two are the ones
there you
added,
go. That's why they're seeing upside here today, and removed 60 Chinese stocks in that quarterly review. We just give you a flavor of some of those 60 right there.
Yeah, I think we were talking about this yesterday, the growing heft of the India part of the EM basket.
Yes.
And you really see that reflected today in the changes. So more deleted in terms of China, small addition. India, more added than deleted. We're not sure, of course, of the specific weightings, but certainly we're closer to that parity, if you could call it that. Right, other big movers we're talking about here. Rakuten up, in fact, up substantially here, narrowing this operating loss The market is responding quite nicely there. KE Holdings is, of course, a company listed here in Hong Kong. And, of course, Crackdown, as you can see on your screens, up about 10%. That is also an earnings story. Again, lots to get through as far as market action goes. Japan is headed to the lunch break. Plenty more ahead. This is the China Show.
11:29 a.m. in Tokyo. Japanese markets are heading to lunch break, and yes, things are doing well. They had a good holiday, it seems, and we're back in terms of adding some more risk on the table for Japan. So the Nikkei 225 is up some 2%. Topics is basically up close to 2. 147 levels for dollar yen, so still continue to see that weakness in the currency here right now. JGB is not doing a whole lot either, Dave.
Yeah, in fact, to Yvonne's point, let me draw your attention to Asia Pacific, and then Asia Pacific ex Japan, which is coming up on your screens. Top right is the benchmark, including Japan. Bottom right is the one excluding it. So Japan is really carrying the cross today. Most sectors are up, but again, that might be most sectors in Japan that are trading to the upside. IT, energy, chips are doing well. There's a lot of big earnings moves in Japan to tell you about, which we discussed, of course, some of them, like Rakuten is up substantially as well. Right, but overall, it's a quiet day. Equity market-wise, volumes are not quite there. On price, you might have missed it. We're now back to levels before the mini Black Monday crisis we had about a week back. So 176 takes us all the way back to thereabout Friday levels, 2 Fridays back. And that's ahead of some crucial numbers, PPI out of the U.S. And, of course, midweek is that, I think we say it every month, that all-important CPI print out of America.
Yeah, but other world news that we're following. Meanwhile, a Bangladeshi opposition party is calling for elections to be held quickly to ensure stability and security. An interim government led by economist Muhammad Yunus has not set a date for a vote. He was appointed after former Prime Minister Sheikh Hasina fled this month amid protests that killed more than 350 people. Moody's Analytics says the unrest has left Bangladesh's economy susceptible to collapse. Sources say Russia and Ukraine intend to keep pipeline gas flowing to Europe despite fighting near a transit point for the fuel. It comes as Ukrainian President Volodymyr Zelensky publicly confirmed for the first time that his forces has seized a swath of Russian territory. He says the operation is being conducted to protect Ukraine's border region. Israel's sovereign debt has been cut by 1 notch by Fitch Ratings as the war in Gaza weighs on public finances. Fitch lowered Israel's score to A from A+, citing geopolitical risks. Fitch analysts see the conflict in Gaza lasting into 2025 with a chance of it broadening on other fronts. Moody's Ratings gave Israel its first ever sovereign downgrade in February, cutting it 1 notch to A2 with a negative outlook.
Okay, let's have a look at oil right now. So massive move up yesterday, 3%. We're seeing that pare back today. What you're seeing in Shanghai crude, though, is somewhat of a catch-up, of course, to what we had overnight, and all things equal. So we are trading at much higher levels than we were about 36 hours back. Certainly let's get you up to speed on all the latest that we know so far is, of course, you have U.S. and Israel sharing this view that an attack is increasingly likely from Iran, retaliation there. And, of course, as the Middle East braces for a strike, you also have, I think, Antony Blinken is headed to that part of the world, of course, on the back of, I think, August 15 are the ceasefire talks in Egypt, and that's a report coming out of Axios. So we'll keep on top of all of the details here on these stories.
We also heard from Rystad Energy. They're downplaying the impact of these geopolitical risks to markets. The oil trading head, Mukesh Sadev, told us he doesn't see heightened tensions in the Middle East triggering a big jump in prices.
I believe that U.S. probably cannot afford Iran out of the equation, and that would really spike up the oil prices, and U.S. elections are ahead. So I guess this is another, announced kind of a move, which will not amount to much like the last time around. So my view would be that from a fundamentals perspective, we should not read too much into this geopolitics. Yes, some hot air, some few dollars up, but we are not talking the 90s or the 100s here.
And shifting gears now, we've been looking at the potential next big risks for markets. Oaktree Capital co-CEO Armen Panossian is warning that the upside potential of artificial intelligence may also come with devastating consequences. He discusses the major factors weighing in on the booming industry.
The biggest risk that I see with respect to the markets and to society in particular is artificial intelligence. Artificial intelligence clearly has the potential for very large economic gains, revenue increases, cost efficiencies. And that investment opportunity is really exciting. It's easy to disregard the societal impacts of those same efficiency gains. What happens to normal jobs that are become obsolete because of artificial intelligence? Think of cashiers or drivers. As artificial intelligence becomes a real alternative to physical labor in some of those areas, millions of people could be out of jobs. So who's going to retrain those people? Because if we don't figure that out, that there will be social unrest, or there could be social unrest because of joblessness. In terms of the markets, artificial intelligence clearly is getting a lot of support from the markets. But just like the internet in the late 90s, there was this promise of revenues growing rapidly. While the gains are clear to see in terms of their potential, the timing of them is impossible enough. And if that timing takes a lot longer than investors expect, I would expect to see pretty violent resetting of valuations and potentially some losses for investors along the way.
What does this look like for an investor who's keeping a close eye on the economy, the job market, let alone investing in AI itself? It seems like the risk you're outlining here could impact many markets.
The attractive part of it and the scary part of it is that there isn't a monopoly on intellect that could be used to develop artificial intelligence technologies. There is a shortage of semiconductors and chips, but artificial intelligence allows economies and countries, and potentially those adverse to the US, to develop certain technologies and skills through artificial intelligence that could be problematic from a geopolitical standpoint. In terms of what investors should be looking at from the economy, it's hard to really have a leading indicator. I think, unfortunately, from the job market perspective, we're going to be looking in the rearview mirror probably after it's too late. So it's really hard to kind of pinpoint what economic indicators we should be looking for.
How do you think about this in terms of how people are behaving right now? Do you think most investors out there are ignoring these risks?
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
And that was Armen Panossian, Oaktree co-CEO, speaking with our colleague, of course, Shonali Basak, on the next big risk. You can watch and catch the full episode now on the terminal, also on Bloomberg.com, or if you have an internet connection, it's on YouTube as well. There we go. All right, just ahead here in shows, China's state-run media hailing a stellar performance at the Olympics as the latest sign it can rival the U.S. on the global stage. More in our China Brief is next. This is Bloomberg.
Here's your China Brief. A look at what's making headlines in national media. The nationalist tabloid Global Times touts China's gold medal tie with the U.S. 40, right, as the latest sign it can rival America on the global stage. The article calls it a reflection of an unstoppable historic trend. With 40 gold medals, it was China's best performance at an overseas Olympics and strongest showing against the U.S. since Beijing hosted back in 2008.
Yeah, and our colleagues at Bloomberg Economics and also Bloomberg Intelligence have been crunching their respective numbers when it comes to China and the sort of Chinese corporates and the presence at the Olympics. Let's bring in Eric Ju, our Bloomberg economist, and also our senior analyst, Catherine Lim, to talk us through these various facets to the Olympic conversation. Eric, I'll start with you. It seems that they're spending less, China's spending less on the athletes in the programs. What does it tell you in terms of their wishes to win at all costs, or not? Yeah. Maybe not anymore.
Yeah, a couple of different explanations. One is obviously, if you look at timeline, it's looks like happened after COVID. So one reason is the economy is down, so the government just don't have as much money as before. So, and probably sports is now down the priority list, right? But the other probably more promising explanation is that some sports now they start to allow more flexible participation in the state-sponsored sports system, right? Usually they rely exclusively all the money maybe come from the state side. So it's a state-sponsored sports system. So athletes, it's all trained, identified by the state system. But now I think some more professionalized sports like tennis, golf, it's more money-making opportunities, right? So parents or private side, they also start to identify and train their own talents outside of the state system. So that means it's required less from the government to investment in those areas. So if that's true, that's also explains why the state funding is less than before, but they still manage to achieve the similar achievements as before. So that's some good news for the government.
Would you say that's the end of China, the state-driven sort of sports system?
Yeah.
Is that coming to an end?
Probably, I think that will still stick for a while because it's had proven to work well, and I don't think they're going to abandon that. But at the same time, I think the government will realize that they can welcome more money from the outside of the system, and especially for those sports I just mentioned. So that will also. It's a win-win situation for both the government and the sports, right?
Yeah, and Catherine, on the corporate side, this neck-and-neck race between Team US and USA and Team China, who have been the biggest winners there?
It was neck to neck all the way until the last day, right?
Yeah,
so,
even after.
So, not going to make any comments on women's basketball finals, but I guess, really there was so much, scrutiny, whether it's the brands and really, the attention span, whether even basketball is amazing because that's one of the most popular sports in China. So you actually had attention and people watching, that event itself. And that's actually also going to be good for the advertising revenues for Tencent's Kuaishou and Douyin. And notwithstanding, of course, I would say that, Nike, was also a beneficiary because of the basketball. And really, I would say that, take a step back. I think the last goal that was actually being clinched by Team China, that was probably weightlifting, if I'm not mistaken. So, we've got Anta actually sponsoring that as well. So I think, it's really across the board for these, 4-5 names. So Nike, Anta, Tencent's Kuaishou, Douyin, congratulations.
What about the tech companies? Are they in a position to gain from this?
Well, you know what? Interestingly, I guess, John, other than the on-demand video content players that I've just mentioned, like Tencent, Kuaishou, and Douyin, Alibaba was actually, in the background, actually testing out the AI technologies for this. But unfortunately, we're not really going to see much coming through because, it's more of a longer-term strategic, partnership that they actually had with the Olympics Committee. And really, I think that's going to be a longer-term thing that they want to go, with the cloud technologies.
Yeah, Eric, back to you. Is it a coincidence that, the U.S. and China, top of the medal standings, just happen to be the two biggest economies in the world, the two biggest superpowers?
Yeah.
Is there a correlation between economic might and success?
I think that's a strong correlation. If you look at top 10 or even top 20 countries on the list, it's loosely, generally associated with the overall GDP of the economy. So I don't think it's a coincidence. It's basically reflecting that the sports achievement also reflects the comprehensive, economic power of the country. And remember, when did China overtake Germany? I think it's in the 2000. Yeah, it's roughly the same time when China's GDP overtook Germany. So I think that's a very good example of how GDP is important for the sports achievement. And when do we expect China to overtake the U.S.? That probably will happen
the economy
until China overtake in terms of GDP, right? I think that's
and Catherine, while we have you here this week, Alibaba earnings. It's going to be a busy day for you. What are you watching out for the most?
Yeah, I guess, busy day, busy week for all those watching tech, whether it's Tencent that's reporting tomorrow, Alibaba, and JD.com that's actually reporting on Thursday itself. I think, stepping beyond China, consumption is where it is, as we know. over the first 6 months of 2024. I think, another area that is actually worth looking at would be the AIDC, the international businesses, because that's where AliExpress was actually sponsoring the UEFA Euro 2024. And of course, there was the cloud part that they've actually played into Olympics as well. So let's see whether there are new developments coming through for AIDC and cloud for Alibaba.
All right. Catherine Lim, thank you, our Bloomberg Intelligence Senior Analyst, and our thanks to Eric Ju, Bloomberg Economist, as well. Fun chat here when it comes to the Olympics. At the end of the day one after the hangover, I guess.
Yeah.
Not much else to watch out
well,
for now.
No,
right?
There's something else that's happening.
No, we're not talking about that.
Okay.
All right, plenty more ahead. This is Bloomberg. All right, big story we've been tracking for you this morning. Bloomberg has learned that General Motors is cutting staff in Chinese market-related departments, and soon we'll meet with local partner SAIC as part of a larger structural overhaul. Our chief North Asia correspondent, Stephen Ingles, joins us for more. And you talked about GM entering this market, Steve, back in the 90s, 2000s, and really being the big sort of European maker. Especially American maker. I should say American, not Volkswagen. But certainly it shows to show the fall from grace.
Absolutely. I mean, it reflects these changes that the sources are telling Bloomberg News, reflects the changes in the market and the Chinese slowdown, the overcapacity that is in the automobile industry there, where local players, according to a lot of sources and analysts, are saying they are basically looking for market share gains, especially in EVs, at the expense of profitability. Well, GM is not a non-profit organization. They need to make a profit, but they lost $104 million on its China business in the second quarter. China's sales plunging 29% in that quarter year over year. So the numbers are way down. 4 million sales at the peak when they were making billions of dollars in profit out of China in 2017, down to just 2.1 million cars sold for GM in China last year. So cut it about in half. Look, GM did have first mover advantage along with Volkswagen. Volkswagen and GM always were jockeying in the 1990s. From 1997, when they began making cars through the joint venture partnership with SAIC and also smaller cars with Wuling, they basically had first mover advantage. Phil Murtaugh, the big auto industry executive, he's a legend from Detroit. He spent 33 years at GM, and he's spent 5 years essentially at the end of his career at GM in China as the chairman and CEO there. And so it was a great, cooperation, if you will, joint venture cooperation between China and the United States. Things have drastically changed right now. The domestic players, especially in EVs, dominate the sales charts right now.
If I'm a VW, I'm a Toyota, and a Honda, am I thinking the same thing right now in terms of some sort of reset?
Well, that's what I got from the people that I talked to at the Beijing Auto Show in May. They won't say it on camera, but they were all trying to find their lost mojo in the China market because, look, China was in the dark ages as far as visibility of the industry through COVID-0. 3 years, 4 years, we didn't have an auto show. We didn't see what they were necessarily doing except what started to appear on the streets. BYD started dominating. You started seeing all these dolphins and the seals and the Atos going on the streets. And the foreign automakers and the executives, they hadn't been to China through that period. They really opened their eyes in May to see, oh my goodness, we've lost that first mover advantage. Yeah. Things have drastically changed. Our numbers are way down. How are we going to recoup that? So that's going forward. What we're hearing from the sources and the news that we got is, in addition to these job cuts across the joint venture partnerships, there's going to be talks with the partner, SAIC, Shanghai Automotive, about potentially a fundamental restructure, reboot of the foundation of their partnership, including possible capacity cuts during this time of overcapacity.
So what do you think is the most important fix that they had to put in place? Because they've, as far as the middle market is concerned, in terms of pricing, they've lost the ability to, the brand value for them to be able to price it at a premium. That's gone away in the 90s, 2000s. So what value can they bring to the table now?
Well, the problem, I guess, is the main joint venture between GM and SAIC really was in that middle segment, okay? And they had Chevy branded cars, also Cadillacs, and essentially what was one of the other, Buick. Obviously, Buick's a big brand in China. They have the GL8 minivan, which was kind of deemed a decade or so ago as the Chinese equivalent to a limousine, right? The minivan went out of favor in the United States long ago, but it's still on the streets, obviously, in China. But again, that's the area that has been really absorbed by the Chinese makers. And also, they were making U.S.-branded cars with SAIC in that middle segment. So where are they going to have to get better profitability because they lost $104 million in the second quarter? Well, it might be with the other joint venture with Wuling. That's SAIC GM Wuling. They make more affordable cars. They make that mini EV called the Hongguan. That might be an area. Their sales in the second quarter were only down 12% compared to 29% for the other joint venture. So they're going to have to find ways to get out of the bleeding red on the bottom line because they've been losing this money.
Steve, thank you so much. Stephen Ingles, there, our Chief North Asia correspondent there. Right, we're not going to go that far back in history, as Steve was pointing out, all the way back to the 90s. We're going back only to Monday of last week, and we've recovered all the losses now on the regional benchmark. And it took Japan a long weekend and it reopened, the catch-up trade today to push us just above levels of last Monday. So yeah, we've done it. We can close this market now. The index is not trading at a level before that rout on August the 5th.
You gotta wonder, right? Is this complacency? Have we forgotten what happened and all the reasons that it led to that sort of meltdown? Or what we learned, was it just the tip of the iceberg, right? These unwind of the carry trades, especially some of the discussions with the BOJ. Those are not really done yet, right? Of what the BOJ could still do, what the Fed could still do. Certainly so, I think, especially the data that comes out, US CPI, that's going to be very, very important to dictate what the flows are going to look like, what liquidity going to look like, and really what the Fed's going to do, too.
Yeah, in case some of our viewers missed it, so in the last hour, Reuters actually reported, to your point, in the BOJ, right, that the Parliament might be summoning the BOJ governor, this special session on the BOJ rate hike. The date of the meeting is August 23, and we understand, based on a Reuters report, that it may be finalized as soon as today, and what that meeting is probably going to look. Anyway, pay attention to that amidst this continued, or the lack of it at this point, fallout from the BOJ hike, which arguably was one of the triggers which led to this. The other story we're tracking today is, at least for now, a relative period of stability in the CGB space. This downdraft we're seeing on the rightmost side of your screens, this drop in about 1 or 2 basis points from the 225 handle on a 10-year yield, following the worst day for 10-year CGBs as far as the futures are concerned, going back to 2023. So it's stable today. We'll see how long and which way traders take this. Shanghai Composite, in case you missed it too, the lowest turnover, not just on the Shanghai Comp, but Shanghai and Shenzhen. Yesterday, tanking to the lowest since 2020. So the lack of interest. Maybe it's summer, maybe it's the state of the markets. Who knows what happens here? So, okay, well, that's it from us here on The China Show. We'll see you all tomorrow.